Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So I want you to imagine pulling out your calendar, blocking off a single Tuesday, and paying $25,000 for an 8-hour class.
Frankly, that sounds like a typo on an invoice.
Right, that is the price of a brand new car, just gone before dinner. But looking at recent analysis of what is happening right now on Wall Street, some of the most high-powered, incredibly busy bankers in the world are, willingly stepping away from their desks to take these $25,000 a day boot camps.
It's honestly wild to think about.
Yeah, and the topic on the syllabus, it's literally just how to talk to artificial intelligence. So today, the mission of this deep dive is strictly for you, the listener. We want to break down exactly why Wall Street is treating AI not as like a fun tech experiment, but as a literal life or death survival tool. We are going to translate these complex financial shifts into plain English so you can understand how the workplace and the stock market are fundamentally changing right now.
And, the sheer dollar amount of that training fee is a massive signal. If the sharpest minds in finance are willing to pay that kind of premium to learn a software skill, they're seeing a return on investment that most people just haven't quite grasped yet.
Yeah, let's start with the mechanics of that insane price tag. The data shows the firm running these highly sought-after sessions is called Wall Street Prompt. It was founded by two former finance guys, Felipe Sinistera and Dave Wang.
Right, and their backgrounds are super important here.
Exactly, because these aren't just software developers from Silicon Valley trying to guess what banks want. They have heavy-hitting backgrounds at places like Morgan Stanley, Goldman Sachs, and SoftBank.
Which means they actually speak the language.
Right, they speak Wall Street. They are charging banks and funds up to 25 grand a day for this AI training, and they are reportedly booked out for months. We are talking about heavyweights like T. Rowe Price, Citigroup, and Bank of America sending their people.
Because that specific, highly regulated language of high finance is entirely different from the language of, everyday consumer tech.
But I have to challenge this premise for a second. I use a basic AI app on my phone to help me write emails or brainstorm ideas, and I pay, maybe $20 a month for it?
Sure, yeah.
So why on earth would a major bank pay the equivalent of a new car for a single day of training? Can't a senior banker just open up an AI chatbot and type in a question for free? Think about learning to drive. Upgrading from a bicycle to a normal sedan doesn't require a $25,000 instructor.
Well, see, that analogy falls short because they aren't upgrading to a normal sedan. They are upgrading to a Formula One race car.
Oh, wow. Okay.
Yeah, and if you put a regular driver in a Formula One car and just tell them to hit the gas, they aren't going to set a track record. They're going to spin out at 200 miles an hour and completely total the vehicle.
And totaling the vehicle in finance means what exactly?
In the world of high finance, totaling the vehicle means accidentally leaking non-public, highly confidential merger data into a public server, or, violating severe regulatory compliance laws with the SEC.
Yeah, so it's about not blowing up the firm.
Exactly. Wall Street Prompt isn't teaching these executives how to write polite emails. They are teaching them the mechanics of building complex investment strategies and running deep corporate due diligence securely.
So the training is essentially teaching them how to feed the machine the right, highly sensitive data without causing a legal disaster.
More than that, actually. It is teaching them how to command the machine to do the heavy lifting of financial analysis. You really have to view that 25 grand not as a fee, but as a conversion cost.
A conversion cost. Explain that a bit.
Well, Wall Street is filled with senior bankers pulling down massive salaries. If you take a traditional senior banker and convert them into an AI-powered super worker, their output capacity changes geometrically.
Right. They just get drastically faster.
Exactly. If that banker, who is now processing data at lightning speed, uncovers a hidden detail in a corporate filing and closes just one extra $500 million deal for the firm,
then that $25,000 pays for itself instantly.
it's a rounding error at that point. The ROI is immediate.
That makes the math crystal clear. But let's look at what this AI-powered superworker actually does on a typical Tuesday afternoon. I want to get into the specific tools because, according to recent analysis, the moves being made by the big players are incredibly aggressive right now.
Oh, absolutely. The landscape is shifting fast.
Take JPMorgan, for example. The data shows they're rolling out AI tools across their entire global investment banking division. JP Diamond even explicitly stated they will be hiring more AI experts and fewer traditional bankers moving forward.
And that is a permanent structural shift from the biggest bank in the country. It's huge.
Right. And it goes beyond just JPMorgan hiring software engineers. Banks like Goldman Sachs and Morgan Stanley are currently testing a highly specialized cybersecurity model from Anthropic called Mythos.
Under a controlled initiative known as Project Glasswing.
Yeah,
Right.
exactly.
Yeah.
Anthropic actually partnered directly with Blackstone and Goldman Sachs to build an entire enterprise-level customized AI system just to handle this kind of integration.
Which makes sense because you can't just use a generic chatbot for this stuff.
Exactly. I like to think of it like a high-end restaurant kitchen. The AI is acting as the ultimate sous chef.
Oh, I like that.
Right. It chops all the vegetables, meaning it reads hundreds of pages of incredibly boring legal documents, quarterly earnings reports, and complex financial filings in seconds. And then it hands everything perfectly prepped to the human head chef.
The senior banker.
Yes, senior banker, so they can just focus on cooking the meal and greeting the guests.
That sous chef analogy is a really accurate way to look at it. The key difference between a public AI and something like Anthropic's Mythos is the concept of a walled garden.
What does that mean for the banks?
Well, Wall Street's most valuable asset isn't actually its money, it's its proprietary data. An open AI trained on the internet knows what an interest rate is, sure.
Right, anybody can look that up.
But a closed-loop AI trained on 30 years of Goldman Sachs' internal, highly confidential merger history, that AI knows exactly how Goldman Sachs negotiates.
Oh, wow. So Project Glasswing is about leveraging that internal intelligence safely so none of that data ever leaves the building.
Precisely. And when that senior banker gets that perfectly prep station from their AI sous chef, it changes their day-to-day schedule entirely. It brings up a huge concept in these reports: customer coverage.
Yeah, let's talk about customer coverage. My understanding is that it isn't just, taking clients out to a fancy dinner. It's the sheer number of touch points and deals a banker can manage simultaneously.
It is entirely about sales leverage. The real goal for these megabanks isn't just saving money by automating tedious tasks. If the AI reads all those dense legal documents, the senior banker suddenly gets maybe 10 hours of their work week back.
And what do they do with those 10 hours?
They pick up the phone, they talk to more clients, they pitch more deals, they expand their coverage radius without the bank having to hire a second senior executive. The AI does the grunt work, allowing the human to focus entirely on relationships and judgment.
Okay, so the senior bankers are out there shaking hands, making more money, expanding their coverage, because the AI is in the back room chopping all the vegetables.
Mm.
But historically, who used to be in that back room doing the prep work?
Junior bankers.
Exactly. The 22-year-old recent college grads working 90 hours a week building Excel spreadsheets. If the AI is doing all the heavy lifting now, what happens to them? I mean, this sounds like an absolute bloodbath for entry-level jobs.
Well, the landscape is undoubtedly contracting for those roles. Look at Standard Chartered. The research shows they are projecting to cut around 8,000 jobs globally by 2030, specifically as their AI efficiency scales up.
Wait, really? 8,000 jobs?
Yeah, so headcount reductions are a documented reality. However, for the junior bankers entering the field today, AI isn't eliminating the need for juniors entirely. It is just eliminating the value of an average junior.
The value of an average junior. That is a really sharp distinction. Let's define what an average junior used to be versus what is required right now.
5 years ago, if you were a 22-year-old who could build a massive, complex financial spreadsheet in Excel at 2 in the morning without making a typo, you were a highly valuable human calculator.
You're a machine.
Exactly. But today, an AI model does that exact task perfectly formatted in about 3 seconds. Simply being fast and accurate at data entry is no longer a premium skill. Its market value has essentially dropped to zero.
So how does a young professional survive in that environment? What is the new baseline skill if it isn't building spreadsheets at 2 a.m.?
The data points to a new core competency called AI fluency. Training firms like Wall Street Prep and Financial Edge are now baking AI coaching directly into the 2026 analyst training programs.
And this isn't just a niche thing, right?
Not at all. 9 out of the top 10 global investment banks are making this mandatory curriculum. They are teaching a fascinating 3-step verification method now.
How does that work?
First, the junior does a specific financial model by hand. Second, they have the AI generate the same model. Third, and most importantly, they meticulously compare the two.
So the job has completely flipped. It used to be about creating the raw data from scratch. Now the skill is entirely about verifying and arguing the data. You have to be like the editor-in-chief of the AI.
Precisely. You are no longer paid to build the spreadsheet. You are paid to know when the spreadsheet is lying to you. This is the whole concept of hallucinations.
Right, when an AI just confidently makes something up. Give me a concrete example of how a hallucination could actually impact a bank. I want to make sure the mechanics of this risk are totally clear for our listeners.
Sure. Imagine an AI is tasked with reading a 500-page commercial real estate lease agreement. The AI might misinterpret a highly specific rent escalation clause that is tied to local inflation metrics.
Okay, so it misreads one tiny clause.
Right, and then it confidently reports that the property will generate an extra $2 million next year. It looks completely plausible on the page. But if the junior banker doesn't catch that subtle hallucination?
The senior banker might misprice a $50 million loan based on totally fake revenue.
Exactly. It's a disaster.
I see it like a structural engineer inspecting a brand new skyscraper.
Mhm.
The AI construction crew built the entire 100-story building in 3 seconds. It looks magnificent from the outside.
But you still need to check it.
Right. The junior banker is the engineer who has to walk through with a flashlight, tapping the walls. If they miss a tiny structural crack in a load-bearing beam, a hallucination, and the bank moves its clients into that building, the whole thing eventually collapses.
That is the exact mechanism of the new junior role. They are the structural engineers of financial data. The human is the final backstop against catastrophe.
That makes total sense. So if this massive structural shift is happening at every level of employment, we need to pivot to the investor angle. Where is the actual money flowing?
That is the million-dollar question. Or really the billion-dollar question.
Seriously, if banks are dropping 25 grand a day on training and millions more on customized tech integrations like Project Glasswing, that money is going somewhere. As an everyday investor, where is the actual capital moving?
According to recent analysis, the financial windfall of this AI boom isn't just going to the companies building the flashy consumer chatbots. The real money is flowing into what we call productivity infrastructure.
Productivity infrastructure. Break that down for us.
Basically, banks are aggressively shifting their CapEx and OpEx, their capital expenses and operating expenses, toward the foundational plumbing that makes enterprise AI possible.
Let's define those terms quickly for listeners who might be newer to reading corporate balance sheets. OpEx is your day-to-day operating expenses, like paying the electric bill or buying printer paper, right?
Right, the stuff you need just to keep the lights on.
And CapEx, or capital expenses, is when a company buys massive, long-term assets, like a delivery company buying a whole new fleet of trucks. So you were saying the banks are making massive CapEx investments right now.
Massive is almost an understatement. They are investing billions into advanced data management systems, enormous cloud computing storage contracts, robust cybersecurity networks.
Wow.
Yeah, and all the physical servers required to process all this information securely.
And we really have to place this massive spending into our current macroeconomic context. Right now, everyday Americans are watching the broader economy under the current Trump administration.
Right, there's a lot going on.
We are navigating shifts in federal interest rates, discussions around tariffs, economic policies, and just the standard unpredictability of market cycles. But what is striking here is that this aggressive spending on AI infrastructure seems completely detached from the normal economic weather.
It really is. Whether rates go up or down, this spending just continues.
Because it is not a discretionary budget item. It is a fundamental survival tactic. It reminds me of the classic gold rush analogy. Don't look for the gold, look at who is selling the shovels. But honestly, this feels even bigger.
How do you mean?
It feels more like the creation of the Eisenhower interstate highway system in the 1950s. Everyone is obsessed with the shiny new cars, the AI models themselves, but you can't drive a sports car at 100 miles an hour if you were stuck in a muddy field.
You need the roads.
Exactly. The banks have to pour the concrete. They have to build the data centers, install the advanced cooling systems, and lay the fiber optic cables. The companies that manufacture the concrete and lay the roads are the ones absorbing all these billions in CapEx.
That interstate analogy perfectly illustrates the capital flow. And if we look at who is actually capable of paving those digital highways, it exposes a rapidly widening divide in the banking sector itself.
The big guys versus the little guys.
Precisely. On one side, you have the mega banks, your JPMorgans, your Bank of Americas. On the other side, you have the smaller regional banks and local credit unions operating on Main Street.
And the mega banks have the capital to pour the concrete. They have the billion-dollar budgets and decades of unique proprietary data to feed into systems like Mythos.
Right. The scale of economics in AI heavily favors the giants. Building a custom, secure, walled garden AI system requires an astonishing amount of capital expenditure. A local regional bank simply does not have a spare $500 million lying around.
So if the local bank can't afford the infrastructure, they can't process loan applications as fast as JPMorgan. They can't do due diligence as thoroughly. They just can't offer the same level of customer coverage.
They completely lose the ability to compete on both speed and cost. Over the next 5 to 10 years, this technological gap could force massive consolidation in the financial sector.
Really, like a wave of mergers.
Absolutely. Smaller regional banks might find themselves completely left behind by the efficiency of the megabanks, forcing them into mergers just to survive. The cost of entry into the AI era is incredibly high, and those who can't pay it will simply be absorbed by those who can.
The big get bigger, and the small get eaten because they can't afford the entry fee. That is a sobering thought, which really brings us to the ultimate question for you, the listener.
Right, how does this actually affect you?
Exactly. Whether you are working on Wall Street, running a small business on Main Street, or just sitting at your kitchen table managing your own retirement account, how does this shift alter your relationship with technology going forward?
Well, the core takeaway across all these data points is that AI fluency is no longer an elective course. It is the new mandatory baseline for participating in the modern economy.
It's just expected now.
Yes. But the golden rule, whether you are a junior banker or an individual investor, is rigorous verification. You can never trust it blindly.
Right. You have to be the structural engineer with the flashlight.
Exactly. The people who win in the future won't be the ones who just know how to type a basic prompt into an AI tool. The real winners will be the ones who know how to ask the machine the smartest, most complex questions, and who ruthlessly audit the answers it spits out.
So the value of human judgment hasn't been automated away at all. It has actually been elevated to the final, most crucial step of the entire process.
Without a doubt.
Human judgment as the ultimate premium asset.
I love that. And that leaves us with a final puzzle for you to chew on as you go about your day. Think about this. If the AI revolution plays out exactly as Wall Street plans, eventually every major bank will have the exact same enterprise AI tools.
They'll have the supercomputers. Right. Those tools will all be reading the exact same global financial data at the exact same lightning speed. If everyone is using the same supercomputer to analyze the exact same numbers, won't they all eventually arrive at the exact same investment conclusions?
That is the big question.
And if that happens, when all the perfect computers tie for first place, does simple, unprogrammable human intuition suddenly become the most valuable asset in the world again?
It really makes you wonder.
Something to think about. Don't forget to subscribe and hit that like button.